Switzerland has no oil, no coastline, no empire, no massive population, and yet its average citizen is richer than almost anyone on Earth. Switzerland didn't get rich by conquering, extracting, or exploiting. Switzerland got rich by being boring. And that might be the most dangerous strategy of all. A landlocked country wedged between Europe's heavyweights. 4 national languages, rugged mountains, harsh winters, very few natural resources. On paper, Switzerland should be an economic footnote. Instead, it became a magnet for global money, global talent, and global trust. When financial crises erupt, capital runs toward Switzerland. When political systems wobble, corporations open Swiss subsidiaries. When wealthy families worry about the future, they move assets into Swiss institutions. This pattern didn't appear overnight. It took centuries of intentional design. While most nations built power through armies and territory, Switzerland built power through reliability. While others tried to dominate, Switzerland tried not to collapse. That difference explains almost everything. For most of European history, being small was a death sentence. Empires expanded outward. Borders shifted constantly. Currencies disappeared. Kings defaulted on debts. Switzerland survived because it refused to play the same game. Instead of becoming strong enough to conquer, it became stable enough to be indispensable. Swiss leaders understood a simple truth very early. If you cannot intimidate your neighbors, make yourself useful to everyone. So, Switzerland specialized in 3 things: neutrality, predictability, and institutional trust. Neutrality wasn't moral posturing. It was economic positioning. War destroys contracts. War destroys savings. War destroys records. Switzerland avoided wars not because it loved peace, but because peace protected balance sheets. Every time Europe burned, Swiss vaults stayed open. Swiss courts kept functioning. Swiss companies kept operating. Over time, that created a reputation no marketing budget could buy. When chaos happens, Switzerland still works. That reputation became its most valuable export. But reputation alone doesn't make a population rich. A country also has to produce enormous economic value. This is where Switzerland's second obsession enters the story: productivity. Switzerland doesn't try to be the cheapest producer. It doesn't try to flood the world with mass market goods. It deliberately positions itself at the very top of value chains. Instead of selling millions of cheap products, Switzerland sells smaller quantities of extremely expensive ones: pharmaceutical compounds, precision medical devices, advanced machinery, specialty chemicals, high-end industrial components. These are not flashy industries. You don't see Swiss medical tubing in Instagram reels. But without these components, hospitals shut down, factories stop, and supply chains collapse. Swiss firms quietly occupy choke points. They don't dominate markets by size. They dominate by being impossible to replace. This strategy allows Swiss companies to charge high prices. High prices fund high wages. High wages create wealthy households. And this only works because Swiss workers are extraordinarily productive. That productivity is not accidental. It starts in school. Most Swiss teenagers do not attend traditional universities. Instead, they enter apprenticeships, real jobs, paid, regulated, connected directly to industry needs. By the time a Swiss worker reaches their early 20s, they often already have several years of experience, professional certifications, no student debt, a permanent job offer. They are not experimenting, they are contributing. This produces a labor force that is useful almost immediately, which reduces youth unemployment, which reduces social tension, which reduces crime, which keeps politics calmer. Another loop. Swiss culture also treats skilled trades with respect. Being a machinist, electrician, or technician is not considered a failure. It is considered competence. That cultural signal matters. In countries where only white-collar careers are respected, talent crowds into offices whether or not the economy needs more office workers. Switzerland distributes talent across the economy. Now combine productivity with taxation. Switzerland is not a low-tax paradise, but it is a rational tax country. Income taxes are lower than in many Western European nations. Corporate taxes vary by canton. Wealth taxes exist, but are modest. Most importantly, Switzerland does not have a single centralized tax system. It has dozens. Each canton sets its own rates. This creates internal competition. If a canton raises taxes too aggressively, businesses leave. If a canton designs attractive rates, companies arrive. Politicians see the results quickly. Bad policy shows up in empty office parks. Good policy shows up in new construction. This pressure prevents extreme behavior. It also creates a powerful psychological effect. In Switzerland, success is not treated as suspicious. Earning more does not trigger social hostility. It triggers higher tax payments but not confiscation. That distinction keeps ambition alive. In many countries, people stop pushing because the reward feels pointless. In Switzerland, pushing still makes sense. Now add one more ingredient: trust in money. The Swiss franc is one of the most trusted currencies in the world, not because Switzerland is large, but because Switzerland refuses to abuse its currency. It doesn't print recklessly. It doesn't inflate away debt. It doesn't turn monetary policy into a political tool. This discipline makes the franc behave like a safe haven. During global crises, investors buy francs. That strengthens the currency. A strong currency makes imports cheaper. Cheaper imports raise living standards. Higher living standards reinforce political stability. Yet another loop. This is what Swiss wealth really looks like. Not skyscrapers, not megacities, not spectacle. It looks like functional institutions, boring budgets, reliable contracts, predictable rules. Most countries underestimate how powerful boring can be. But Switzerland built an empire of boredom. However, every system that works too well eventually creates its own risks, and Switzerland is no exception. Housing is becoming painfully expensive. Immigration is politically sensitive. Global tax harmonization threatens Switzerland's competitive edge. Geopolitical pressure is rising. Neutrality is harder to maintain in a polarized world. The same stability that built Swiss wealth can also make change slow, which raises an uncomfortable question. Is Switzerland's model permanent, or is it a perfect system for a world that no longer exists? Switzerland's reputation was built long before modern finance, but modern finance amplified it. People still imagine Swiss banking as secret vaults, anonymous numbered accounts, and shadowy deals. That version of Switzerland largely died in the 2000s. Under pressure from the United States and the European Union, Switzerland dismantled formal bank secrecy for foreign clients. Automatic information exchange became standard. Tax evasion stopped being legally protected. So, why did Switzerland remain rich after losing its most famous advantage? Because secrecy was never the core product. Stability was. Swiss banks pivoted from hiding money to managing it. Wealth management, asset preservation, family offices, trust structures, succession planning. These services are not about avoiding taxes. They are about preventing stupidity. When someone accumulates significant wealth, their greatest enemy is rarely theft. It is bad decisions, divorce, family conflict, poor investments, political chaos. Swiss financial institutions specialize in building boring conservative structures that protect wealth from human error. They don't promise extraordinary returns. They promise that your grandchildren will still be rich. That promise is incredibly valuable. Switzerland also offers something subtle but powerful: legal predictability. If you structure an investment vehicle in Switzerland, you can reasonably expect that the law governing it will not be radically rewritten next year. In many countries, laws change retroactively. In Switzerland, that idea is considered close to heresy. This predictability attracts long-term capital. Long-term capital behaves differently from speculative capital. It doesn't chase memes, it doesn't flee overnight. It builds factories, funds research, finances infrastructure. Long-term capital makes countries rich. Short-term capital makes headlines. Switzerland optimized for the boring kind. Now layer on multinational corporations. Hundreds of global firms place regional or global headquarters in Switzerland. Not necessarily because they manufacture there, but because they coordinate from there. Corporate strategy, treasury operations, legal domiciles, intellectual property management. Switzerland offers stable courts, business, friendly regulation, low corruption, highly skilled multilingual workforce. Executives can operate in English, German, French, and Italian inside the same building. That matters more than people realize. Switzerland quietly became a nerve center of global corporate coordination. Not loud, not flashy, extremely profitable. This brings us to a critical distinction. Switzerland is not rich because it has a lot of billionaires. It is rich because its median citizen does well. Many countries have extreme wealth at the top and stagnation below. Switzerland has broad prosperity. Income inequality exists, but it is lower than in most developed countries. Not because Switzerland redistributes aggressively, but because wages across the distribution are high. That is a fundamentally different model. Now let's talk about housing, because this is where the Swiss model starts to show cracks. Switzerland's population keeps growing, mostly through immigration. Skilled workers, EU professionals, engineers, healthcare staff, researchers, all moving in, but housing supply is tightly controlled. Zoning laws are strict. Environmental protections are strong. Local communities resist dense construction. The result is simple: demand rises. Supply barely moves. Prices explode. In Zurich, Geneva, and Basel, rent levels rival London and New York. Buying property is out of reach for many young Swiss. This creates a quiet generational tension. Older Swiss often own valuable real estate. Younger Swiss rent indefinitely. Wealth increasingly comes from inheritance rather than work. That pattern is dangerous. Because once a society transitions from earned wealth to inherited wealth, social mobility declines. Switzerland is not there yet, but the trend exists. Another pressure point is immigration. Switzerland relies on foreign workers. Its economy would shrink without them. But rapid population growth strains infrastructure. Trains get crowded. Rents rise. Schools fill up. Hospitals face capacity issues. This produces political backlash. Referendums regularly attempt to limit immigration. Business groups fight these measures. Voters are torn. They like high wages. They dislike overcrowding. Both cannot be maximized simultaneously. This tension will define Swiss politics for decades. Now zoom out. Switzerland's model assumes a world where trade remains open, capital moves freely, rules-based globalization persists. That world is weakening. Great power rivalry is rising. Sanctions are used more often. Supply chains are being reshored. Financial systems are fragmenting. Neutrality becomes harder to maintain in a polarized world. Switzerland's historical strategy depended on being useful to everyone. What happens when the world divides into hostile blocs? Can Switzerland stay neutral if major powers demand loyalty? No one knows. Another emerging threat is global tax coordination. Large countries increasingly push for minimum corporate tax rates. They don't like small nations competing. From their perspective, Switzerland is a problem. From Switzerland's perspective, tax competition is survival. This battle will shape the next decade. If Switzerland loses its ability to set attractive tax policies, its corporate ecosystem weakens, not collapses, but weakens. Even small erosions compound over time. There is also cultural change. Younger generations are less deferential to authority, more skeptical of institutions, more likely to question capitalism itself. Swiss wealth depends on high trust in systems. If that trust erodes, the entire model becomes harder to sustain. None of these risks guarantee collapse, but they do guarantee friction. Switzerland is entering a more difficult phase. The era where simply being stable was enough is ending. The future will require adaptation. The good news? Switzerland has advantages few countries possess. It has low debt, high human capital, strong institutions, deep capital pools, political mechanisms that allow incremental change. Most countries wait until crisis forces reform. Switzerland tends to adjust before catastrophe. That alone dramatically improves survival odds. Which brings us to the deeper lesson. Switzerland is not rich because it is special. It is rich because it behaved rationally for a very long time. It avoided shortcuts. It avoided populism. It avoided imperial fantasies. It avoided debt-fueled illusions. It chose slow compounding over fast growth. That choice looks unimpressive in any single year. Over centuries, it becomes unstoppable. Switzerland's greatest strength has always been its relationship with time. Most governments think in election cycles. 4 years, 5 years. Switzerland thinks in generations. That difference compounds more than any natural resource. Swiss political culture is slow on purpose. Reforms crawl, debates drag on, referendums delay decisions. From the outside, this looks inefficient. From the inside, it functions as a stability filter. Bad ideas struggle to pass. Extreme swings get diluted. Nothing moves fast, but very little breaks. This is why Switzerland rarely experiences dramatic booms, and why it rarely experiences catastrophic busts. The system trades excitement for endurance. Over long periods, endurance wins. But endurance alone doesn't guarantee future success. The world Switzerland mastered is disappearing. Globalization is fragmenting. Technological disruption is accelerating. Geopolitical blocs are forming. Neutrality is becoming harder to sell. Switzerland must now answer a question it avoided for centuries. How do you remain indispensable in a world that is choosing sides? One strategy is already visible. Switzerland is doubling down on being a center of knowledge, artificial intelligence, biotechnology, advanced materials, life sciences, quantum computing. These fields reward precision, patience, and deep expertise. Swiss universities and research institutes punch far above their weight. Public and private R&D spending remains among the highest in the world relative to GDP. This is not accidental, it is strategic. Switzerland understands that manufacturing margins will compress over time. But intellectual property scales, a patented drug, a proprietary process, a unique algorithm, These generate global revenue with minimal physical footprint, perfect for a small country. Another pillar is energy. Switzerland invested heavily in hydropower and nuclear decades ago. This gives it one of the cleanest and most reliable electricity grids in Europe. Energy stability supports industrial competitiveness. It also shields Switzerland from geopolitical energy blackmail. In a world where energy security is returning as a national priority, this matters enormously. Now, let's address the uncomfortable truth. Switzerland's model cannot be fully copied. It relies on historical path dependence, centuries of accumulated trust, unique political structures, geography that encourages decentralization, small scale. Trying to replicate Switzerland overnight is like trying to replicate Silicon Valley by building an office park. It misses the point. But parts of the Swiss philosophy are transferable, not the policies. The mindset? First, treat stability as an economic asset. Most countries treat stability as boring background noise. Switzerland treats it as product. Second, build institutions before distributing wealth. You cannot redistribute what you cannot sustainably produce. Third, respect skilled labor. Societies that worship only academic credentials waste enormous talent. Fourth, fear debt, not morally, mathematically. Debt reduces future choices. Fifth, design systems that assume humans are flawed. Swiss institutions do not assume politicians are angels. They assume politicians are humans, so they constrain them. That humility is rare. Now let's talk about inequality. Yes, Switzerland has rich people, very rich people, but its real success is that it avoided mass despair. A truck driver in Switzerland does not feel like a disposable human. A factory worker can raise a family. A nurse can live independently. These are underrated achievements. In many countries, economic conversation focuses on billionaires. Switzerland quietly focused on making sure ordinary life works. That is a higher bar. But it also creates a paradox. When a society works reasonably well, urgency disappears. People become complacent. Reform energy declines. This is Switzerland's biggest long-term risk. Not collapse, complacency. If housing becomes permanently unaffordable, if younger generations feel locked out of ownership, if immigration tensions escalate, if innovation slows, the Swiss social contract could fracture, not explosively. Gradually, the dangerous kind. Switzerland's future will be decided by whether it can evolve without panicking. So far, history suggests it can, but nothing is guaranteed. Which leads to the final question. Why does Switzerland's story matter to you? Because Switzerland proves something uncomfortable. Wealth is not primarily created by heroic leaders, not by revolutions, not by grand national projects. Wealth is created by thousands of small, boring decisions repeated consistently over long periods. Most societies fail not because they make one catastrophic mistake. They fail because they tolerate many small bad habits. Switzerland did the opposite. It tolerated boredom. It tolerated slow progress. It tolerated incrementalism. And those tolerances compounded into extraordinary wealth. Switzerland did not get rich fast. It got rich slowly. So slowly that nobody noticed. Until suddenly everyone did. That is the real lesson. There is no shortcut. There is no hack. There is no magic resource. There is only structure. Incentives. Discipline. Time. Switzerland mastered all four. That is why Switzerland is so ridiculously rich.